afternoon and welcome to another edition of Unlock the Stock. As you know, it is designed for retail investors to gain access to corporate management and to get to know them and their companies better. This episode is sponsored by Easy Equities, the platform that helps you to grow and protect your wealth. You can invest in local and international shares, property, unit trusts, cryptos, bonds, and actively managed ETFs, plus get access to Easy Protect life insurance and Easy Credit lending to back your financial journey. We are pleased to welcome back to Unlock the Stock CA&S. Duncan Lewis, the CEO, and Frans Rech, the CFO, join us today and will soon take you through their presentation. Unlock the Stock is only possible with our technology partner, Lumi Global. You can visit their website, lumiglobal.com, to learn more about their various online AGM and investor presentation solutions. Our hosts today, as usual, will be the finance ghost and Mark Tobin of Coffee Microcaps. They will lead the Q&A session. Before we start, there are just a few housekeeping notes. Duncan and Frans will take you through a presentation which will be followed by Q&A. You can post your questions by typing them into the Q&A box, which is at the bottom of your screen. The event is being recorded and will be available on the Unlock the Stock YouTube channel next week, together with about 40 other videos that you can take a look at. You will see an email address when we begin the Q&A, and if you would like to be added to CA&S's distribution list, please send an email to that address. Jonathan, I am ready for you to share the presentation now, and then Duncan, you can take us through the presentation.
Thank you, Vanessa, and very good afternoon to you, the team and your audience. Great pleasure to be with you. If I look at the agenda and what I'm going to cover today, I'm going to talk a little bit about who we are, what we do, and why we do it. Briefly talk about our business model, some operational insights, cover a little bit about the highlights of our year ending 24, a deeper dive into the various jurisdictions and their performance. And then I'm going to hand over to my colleague Frans, who's going to talk in greater detail around some of the numbers, and then wrap up with an outlook, and then hand over to the floor for Q&A. It's my intention to get through this in 30 minutes or less, and guess most of you are familiar with our business by now, and I think that some of the slides I'll just do a brief overview of. So thank you, Jonathan. If one looks at who we are and what we do, we primarily are a route to market solutions provider for brand owners in the consumer packaged goods space. Essentially what that means is we're providing a solution to the brand owner to get their brands into a retail environment and helping them to win in that environment, in other words, to grow sales, grow market share, and ultimately the category. The how we do it, Jonathan, if you look at the how we do it, there are four core offerings, and that is warehousing and distribution. There's the retail execution and advisory, the retail support, and lastly, the technology and data solutions that underpin it. If I look deeper into the warehousing and distribution solutions, so we operate, next slide, please, Jonathan. If I look at the warehousing and distribution outside of South Africa, we provide what we would call a full service offering, which would be walls, wheels, distribution, in-store execution, carrying the stock, etc., etc. Now, an important part of having the in-country infrastructure is the ability to get stock to the retail stores within 24, 48 hours. That means that the retailer themselves doesn't have to keep big stocks, and also they can take advantage of key trading periods, month ends, public holidays, seasonality, etc. If you look at the retail execution and advisory, we have in Southern Africa, just over 15,500 people. And by and large, those people are deployed in the retail environments to receive the stock, to physically pack the shelves, to do the promotions, to do the stock takes, to do the order replenishment, activate the sales, engage with shoppers and consumers, conveying features and benefits. And that's what the brand owner is expecting us to do. If I go further around the retail support would include the point of sale and communication around the brand. So we would do physical point of sale material. We would build displays in stores to highlight new innovations, or to do promotions around special pricing, line extensions, and really to ultimately grow basket size in key categories. Lastly, to talk about the technology and data. The technology and data is both an internal and external tool. Internally, it's how we manage our workforce, which is by and large remote. We know through technology where our staff are, what tasks they meant to be performing, and whether or not they've executed those tasks, and where we've been unable to carry out a task or we have a failed delivery, we have a system of escalating that through the organization to ensure that we address service failures very, very quickly. But also it's an important tool of how we communicate with our brand owners around the efficacy of implementation, around competitor activity, or any other data that they want from the coalface. If you look at our footprint, we are by and large a Southern African solution for brand owners, and more recently into East Africa. So we're in 10 countries in the continent, and with our mobile technology platform, Mac Mobile, we're in a further 6, and that would include markets like Malawi, but also some key markets in West Africa where we do the sales management for some of our clients in the predominantly liquor distribution space, carbonated beverage space, etc., etc. If you look at the footprint, I think that we talk about 54 countries in Africa. We have what we describe priority markets, and the priority markets are the markets where we believe we can win. We by and large have a client-led growth strategy, and I think that we're looking for markets where we have positive GDP growth, markets where we feel that we can navigate the governance and fiscal framework, markets where there's rapid urbanization, and where we have GDP growth, rapid urbanization, it acts as a catalyst for expanding modern trade. And that is good for our business model. And it's in markets like that where we experience exponential growth. If you look at the clients, our typical client would be what I would describe as a multinational, most of them American multinationals, albeit that we represent many of the local food manufacturers. I think that we typically try to partner with tier 1 brand owners. And I think we're very privileged that we represent probably the top 200 consumer brands in the world. If you look at our business model is really, I think the only thing worth highlighting is that we're very specific around not making a margin on stock. We typically want to make a margin on the service that we provide a brand owner. So we would let the brand owner manage the relationship with the retailer, and between the retailer and the brand owner, they manage the RSP, and we would typically earn a fee as a percentage of the RSP for executing a series of tasks. And we do that because we don't want to compete or seem to be competing with the retailer for margin. Also, we want to be very transparent around how much our margin is. If you look at the businesses that make up the group, it's a fairly busy slide, so my apologies, but you'll see the core services I referred to earlier, but also which businesses offer which services in which geographies. Moving on to what is described as operational competence. I think that over the years we've become fairly good at, we comparatively speaking have a very low staff turnover in the business. I think that we have, if you look at the geographies, we have very deep in-country roots, knowledge of the categories, knowledge of the retailers, and generally speaking, in the geographies, the management come from that particular geography, understand it well. And I think it's the combination of understanding the geography, understanding the retail landscape, that has really worked in our favor. And if I move on to, I guess, competitive advantage, I'm always nervous to talk about competitive advantage because it's an ongoing journey. But I think that some of the building blocks are a senior leadership team that are highly engaged, heavily invested in the business, both emotionally and otherwise. But I think that the leadership team has grown up in the business, generally speaking, have been owner-operators who have evolved with us through the organization. And in some of the businesses, we already, I guess, migrated to the second generation and the third generation of leadership. I think that we're able to offer clients a very robust solution in the sense that we offer them a solution across multiple geographies, but also in many different retail environments, whether it's across modern trade, wholesale, main market, pharmacy, quick service restaurants, forecourts, etc., etc. The other thing is that the average client has been with us for 19 years. There are some that go back to inception of over 50 years. So I think the point is that we understand those businesses, we understand the categories and the brands very well, and I guess the brand's position in those geographies. And then if you look at our financial and fiscal framework, I think that we're fairly conservative. I think that generally speaking, we have a strong balance sheet, good cash flows, and I think that that has stood us in. I guess that served us well, particularly in tough times like COVID, for example. And I think that as a result, we'll set to continue that. If you just look at the drivers of the business, if you look at the center, we talk about attained through diligent collaboration with clients and their brands. We represent brand owners, and therefore we have a very collaborative relationship with the brand owner. So CA&S is around collaboration, activation, and sales. So we collaborate with the brand owner to understand their brand plans, their respective channel plans, and based that we do a field operations plan, which we try and execute meticulously. And if we execute that meticulously, we'll deliver the organic growth in terms of increased sales, increased market share, overall category growth, and the brand owner will give us opportunities in other channels and or geographies. And that's been, by and large, how we've been able to grow the organization. Moving on to the financial results for the year ending 24. Just a summary, revenue growth. We were able to grow revenue by just over 10% to 10.6%, ending on 12.52 billion. If you look at the headline earnings per share is up just over 25%. If you look at operating profit and earnings per share, up 4.7 and 1.3% respectively. I think that has been impacted by the gain on bargain purchase in the year 23. And stripping that out, operational profit grew over 25% and earnings per share over 27%. Dividends, we declared a dividend of increase of just over 24.9%. And the previous year, and finally net asset value per share just over 17%. If you just look at the evolution of the business, I think that we talk about growing revenue. So internally, we have a target of growing revenue at a compound average growth rate of 20%. We have averaged over the period, I think, a compound average growth of just over 15%, falling short of our internal target. But here you can see the evolution of the business over the last 5 years. But the revenue growth is a proxy for profitable revenue growth. And I'm very pleased that we've been able to grow the margin over the time from 2.9 and last year to 5%. If you compare 23 to 24, you'll see the net margin, the net profit after tax was 5.3 and 5%. That was because of the gain on bargain purchase, which Frans will unpack later. So thank you, Jonathan. I think that we're on an ongoing journey to make sure that we have a nice revenue mix in the business between walls, wheels, and distribution and other services. And as we continue our journey, we want to evolve the business from an 85-15 split to a 70-30 split from a revenue contribution point of view, 70% being warehousing and distribution, and 30% on retail services. The retail services are generally margin richer. They are strategic in nature. They contribute to our competitive advantage. And hopefully, if we get that right, we get a 50% even split between margin contribution of 50-50. If I move on to the segmental overview, I'll start with Botswana. Our Botswana business grew revenue by just over 9% to 5.7 billion. No, this is incorrect. In the previous year, it was 5.7 billion. In 2024, it was 6.2 billion. If you look at Eswatini, we were able to grow revenue by 10.4%. To just over 1.86 billion versus the previous year of 1.6 billion. Namibia, we were able to grow. If you look at Namibia, we were able to grow revenue by 6.5% to 2.26 billion from the 2.1 in the previous year. And then South Africa growing revenue by 18.6% to 1.8 billion. And then finally, the all other countries, and all other countries would be Lesotho, Zimbabwe, and Zambia, growing revenue there just over 28% to 343 million rand. Next, Jonathan. If you look at Botswana specifically, you heard me talk about the revenue growth, but delighted that we were able to grow EBITDA ahead of revenue to 12.6%. I think that this is obviously a big geography for us, contributing 50% of the revenue. This business and geography continues to deliver results for us. We were awarded Master Distributor of the Year for 3 of our big clients. We continue to expand in this geography. Our Smithshine moved our Smithshine business into a further 10,000 square meter facility, expanded our chilled and frozen offering, and we've created a nice foundation for growth in that business. Moving on to Eswatini. Eswatini, we were able to grow revenue there by 10.4%, as you heard me say. EBITDA, not quite as good as the revenue growth. EBITDA grew by 8%, but I think that we have spent the last 2 years investing in capacity in this business, and so that has been from a technology point of view. We have beefed up the team in key areas, and we have also expanded our facilities, and those factors are the contributing factors to affecting the EBITDA. If I move on to Namibia. Namibia, we've had a lot going on in that geography, and so we have rapidly grown that business to what you see here as a 2.2 billion rand business. That was also, we also did an acquisition in 23 of the Tobin Corson business, and in that process spent 23 and 24 bedding that acquisition down. We have, I guess, been very fussy around what clients we want to do business with, what areas we want to play. We've settled that in, and I think that we're expecting this business to continue to grow at double digit, and the margin to expand accordingly. Moving on to South Africa. The South African business did really well, growing at just over 18%, but EBITDA growing at over 50%. I think notwithstanding the performance, we still believe that this business has lots of runway to grow, bearing in mind from a revenue point of view, we consider them a so-called number 2 player, and the number 1 player by revenue would be, I would estimate, at least twice the size. This business is the biggest employer in the group, and I think that, with the South African lens on, I think it's been a very good ambassador for the group, in the sense that it's one top employer for 5 consecutive years. It's a BE level 1 contributor, and our staff in the business own 25% of the business via a staff trust. If I move on from there, back one, please, Jonathan. I just to all the other countries. So anyway, I beg your pardon, just carry on, please, Jonathan. I'll come back to that. If I look at the retail trading landscape, I'll try and get through this quickly, but what I'm trying to demonstrate here is the value of the FMCG business in South Africa of just sort of 800 billion. But if you look at how it's made up between corporate retail, which is really the listed retailers, you look at the independent retailers, which would include Massmart and some big independents like Africa Cash and Carry and KitKat. And then at the bottom, you'll see the main market. The main market is estimated to be about 200 billion, but 200 billion and growing. And we have looked for a solution to provide clients with a solution in that space, because they believe they're under-indexed there, which of course we agree with. And if we are able to provide a credible solution there, we can grow distribution and overall demand. So next slide. So I think that because it's a growing market, we're under-indexed. We look for an acquisition, and in March last year, we did an acquisition in the space of Roots. Roots operates, the next slide, please, Jonathan. If you, Roots Sales and Merchandising operates in the space. They've been doing it for over a decade, and so we believe that we can grow this business exponentially as we provide solutions both in the liquor space and the grocery space for our clients. But more importantly, that we believe that we can create a long-term sustainable business in South Africa that we can take learnings from and replicate in other parts of the continent that we operate in. Thank you. If you look at all the other geographies, I think admittedly of a smaller base, but growing revenue at just over 28%, EBITDA significantly. And I think that our Lesotho business, we're getting some nice momentum there. We've got the regulatory stuff settled, etc. And as we speak, we're onboarding 2 of our tier 1 clients in that geography. So we expect some significant growth out of there. Zimbabwe for us continues to perform. Of course, it's a difficult jurisdiction, difficult to manage, but we've been able to navigate our way to create a sustainable business and within the risk framework that we're comfortable with. Zambia, a little bit more disappointing, by and large, just because of the cost of operating there with load shedding that's, I don't know, between 12 and 20 hours a day. As a result of that, we exited at some categories, but we still think it's strategically important to remain there. Thank you, Jonathan. I'm going to hand over to my colleague Frans now, just to talk around the financials in greater detail. Thank you, Frans.
Thank you very much, Duncan. Good afternoon, everybody. As Duncan said, we have going to deep dive now into the financials. I hope you guys have settled in because it's going to take us about 14 months to go through all the numbers, but I'll spare you that and I'll just go touch base with some of those numbers, like our revenue growth of 10.6%. I see this last year as organic growth year. 10.5% of that revenue growth was related to organic growth. We split the organic growth between new clients, volume growth and price increases. Volume growth was 4.3%, price increases 3.7%, and the new client contribution was 2.5% of that 10.6%. If you look at our adjusted EBITDA number, we call it adjusted because we stripped it for the once-off bargain purchase in Namibia for the Tobin business of 123 million. So if you look at that EBITDA number, a nice growth of 23.8%. If you look at the segmental numbers, there are some countries that has bigger growth and some countries that has got lower growth. But all of that relates to one-off items, basically 2 of them. In the current year, which we have the Mac Mobile acquisition, where we had to do a fair value adjustment of 15 million gain, because it was an associate, and then we also had some write-off of legacy issues in Namibia, which is once-offs and it should be cleaned, and that in a group perspective is a net of about 2 million, but in the segmentals shows a little bit different numbers. If you look at the profit after tax, a small growth of 2.7%, excluding our once-offs in the major once-off in 2023. We also have had a growth of over 20%, and all of that has escalated or cascaded down to a good, healthy headline earnings of 585.2 million and headline earnings per share cents of 122, which is a milestone which we achieved this year. We broke the 100 cents. If you go to the next slide, Jonathan. We've got a nice healthy balance sheet. We have expanded some, we invested in warehouse space, as Duncan's mentioned, in Botswana, and also the other facilities we had to make some adjustments in racking and things like that to make it more efficient and create space. And acquisitions is also included net assets, looking at our current assets and current liabilities, which is basically our main focus areas, because if we manage that good, we have a healthy balance sheet. Inventory 25% of our net current assets, 49% is trade and other payables, and 29% cash and cash equivalents, which includes bank balances of 1.1 billion. If you look at current liabilities, so just going to see there 70% made up of trade and other payables, borrowings 20%, and that includes an overdraft facility of 332 million, which is lower than last year. Next slide, please, Jonathan. If you look at our working capital days is 39 days, same as the previous year. Receivables, we have a healthy debtors book with nominal bad debts. Inventory is in line with our agreements with our clients, because when we sign agreements with our clients, we have to keep a minimum stock levels in our warehouses, and payables slightly higher than the previous year, which we benefited from, but it's all based on timing. Next slide, Jonathan. So if you look at our free cash flow, we generated 441.2 million. And that's due to good cash generated from the operations, as well as managing the working capital to a lower amount than the previous year. Taxes includes withholding taxes that are dividend withholding taxes, specifically from dividends extracted from the regions. But taxes paid is always also a check if we make money. So if we pay taxes, we are making money, and that's a good contribution. We also contribute to the local fiscuses of these countries we operate in. Net interest up from the previous year, 29.9 million, and that's due to our good management of our treasury in the group. Net investments, that 72 million. Basically, it's a root transaction, which we did in March, and then we roll up in our shareholding in Mac Mobile, constitute that 72.9 million. Net capex includes expansions and maintenance in line with our capital allocation. Thank you, Duncan. I'm just going to hand it over to you now.
Thank you, Hans. If I briefly look at an update of what that might look like, we remain committed to, well, Jonathan, I think that what's maybe worth pointing out here before I move on is that, the retail sales are growing ahead of GDP, which is a good thing, but also we have seen food inflation slow. So if you look at the end of 23, food inflation was probably 11 or 12%. Now we see it at just under 4%. And we also see CPI at below the same time last year. So, I think that notwithstanding the fairly static GDP growth in the retail sector and food specifically, things seem to be under control, comparatively speaking. Moving on. Next slide, please, Jonathan. Just with regards to the 20 billion, the 20 billion remains our ambition. And I guess that's what keeps us motivated and puts a pebble in our shoe. But, the 20 billion rand dream has always been the proxy for profitable revenue growth. And, I think the building blocks of that are, you heard me talk about a client-led growth strategy, but the building blocks of that remain, growing channels, growing geographies with existing clients, the acquisitions in strategic areas that are potentially margin richer, that can contribute to our competitive advantage. And so, that has been, I guess, our framework for how we've tried to grow the business, and that remains in place. Jonathan, if you look at the 5-year next slide, if you look at the 5-year growth plan, I think that if you look at 19 to 24, we've had a fairly good compound average growth rate, but short of the internal ambition we have set ourselves. I think that we said we wanted to become a 20 billion rand business by 2026. I think that whilst we'll definitely achieve the 20 billion. What's not certain whether we'll achieve the 20 billion by 2026. And I think that what we want to do is make sure we run a sustainable, profitable, and predictable business and build on the foundation that we've created. If that means we end 2026 at an 18 billion or a 19 billion rand business, so be it. Overwhelmingly, we want to do it within a framework that we are comfortable with and not do anything silly. Moving on, Jonathan. I think that, we have a very well-established business in Southern Africa. In March of this year, we announced the acquisition of Tradco, which is headquartered in Kenya. They have operations in Kenya, Tanzania, and Uganda, servicing a population of close to 200 million people. And our ambition is to, replicate the success we've had in Southern Africa, in East Africa, and based on the macros I discussed earlier, but also on the capability that the Tradco team have had. Already, we have existing clients asking us to provide solutions. And as we speak, we're in an RFP process with 2 of our big clients around potentially providing solutions in that geography. I'm really excited about what that could bring for the business. I think that it's very possible we can replicate what we've done from a revenue contribution in East Africa over the next 5 to 10 years, what we've done in Southern Africa. So, Jonathan, I'm going to leave it at that, and then I'm going to hand over to the floor and take questions. Thank you.
Duncan, Franz, thanks very much for joining us once again. Duncan, maybe we'll just keep going on the point you were talking about there in East Africa, and those RFPs. I mean, you reference earlier in the presentation, 19 years is kind of the average client length. So obviously in this industry, people don't move the distributors or that portion of their business lightly or on a regular basis. So if we take whether it's PepsiCo or Diageo or Unilever, and they've got an excellent relationship with you in Botswana and South Africa, for example, but they also have a long-standing relationship with somebody for those East African markets. I mean, how likely is it that you can get them to move across to Tradco now that it's kind of your partner, your JV on the ground there, or is it a case of it will naturally evolve, as you say, over the next 5 or 10 years, and it's definitely not going to be something that will happen overnight, or do they just see it as too much of a concentration risk? We don't want to have one provider across all these markets. While it sounds great in theory, but from somebody in the risk department will say, no, we need like these different providers in different markets, or maybe not markets, let's say regions. And maybe just give us a better sense of like how customers actually move from these providers within the industry.
Yeah. So in my experience, Mark, is that when we engage a new client, it can take anything from 6 months to 2 years to get them across the line. And that is because they generally speaking, enter into arm's length RFP processes that are run by international procurement and often by third parties like their auditing firms, etc. Also they need to exit existing relationships. So in other words, they might have a 3 months notice period or a 6 month notice period. It's certainly not a silver bullet, and it doesn't happen overnight. Also, I think that if you look at it from our existing clients' point of view, we've done business with them for a long time. So I guess there's a high level of trust and credibility. And also because we're able to offer solution across multiple geographies, we've reduced complexity, and with that comes reduced costs. So, we're operationally effective and we're efficient. And so they would look to get those effective implementation and efficiencies in markets. And so, I think that we, on balance, have, I think, a nice opportunity to grow with existing clients in those geographies. And I think that by and large, we'll be successful in that space.
Okay, thank you.
Hi, Duncan. Always good to have you on here. Thank you. And thank you to everyone for joining us. So I got a question in my DM straight off the bat, and I think it's a goodie. So let's deal with that one, which is just around your cold chain strategy versus dry goods, and just an understanding of, I suppose, where are you focused in terms of capital allocation? Do you see one as being more important than the other over time? There was a comment made around the cold chain facilities in Namibia, so that's what's triggered the question. So yeah, just to help this chap understand what you're doing there on those two options going forward, I suppose.
Yeah. So the bulk of the business is built on ambient and has always been and likely to be a significant remain a significant part of the business from a revenue contribution point of view. But they're also with chilled and frozen, where we have the capacity in place, like for example in Namibia, it presents an opportunity for us to partner with new clients. For example, in the geographies, we have an opportunity to partner with retailers, so to provide them with solutions in country. And so, I think that is traditionally we've done business with brand owners exclusively. And now that we have chilled and frozen space, it enables us to partner with people like that. We also have some key channels like quick service restaurants that we haven't traditionally done business with. And so I think that where we can operate in a niche, we can create competitive advantage, we can do it effectively and earn a margin. We'll do it by exception, and that's what we're focused on, sir.
Duncan, I've got one here, and it's also kind of timely, and it was in my kind of list of questions as well on trade tariffs, trade wars, whatever you want to call it. I mean, I guess you're at the pointy end of it, to some extent. But have you seen anything to date, moving stock in ahead of, what might be happening, adjustments to supply chain, sourcing from one market versus another market, or just, do you think it's going to have in the context of your business, a net neutral, there'll be a few positives, few negatives, but like overall, it's not really going to impact, while the companies themselves at a global level, if we talk like somebody like Unilever or Diageo might feel it in the markets that you operate in, maybe a few positives and negatives, but overall kind of nothing really to move the needle.
Yeah, so Mark, I don't want to talk about a specific client, but I've spent the last week really trying to get our head around it, and I've spoken to the leadership of our major clients. And, I think if you look at our biggest client by way of example, they produce 98% of what we stock locally. And what I mean locally, regionally, they produce it. They import raw materials like oils for soaps, etc., etc. And it's not affected by the so-called trade wars. There's one SKU, or one stock keeping unit, that they do import from the States, but it is, as from a revenue contribution point of view, I mean, it is really, really tiny. I think that, so by and large, I think that we're not going to be impacted, but of course we continue to watch the space and the space very carefully. And, you know, I think related to this question, Mark, is VAT, you know, so, you know, are our brand owners going to absorb it? Are they going to pass it on? Are they going to pass it on? What's going to happen to the consumer? So I am, you know, trying to understand that very, very carefully. One of our brand owners have said emphatically they're just going to absorb it and, you know, see how it goes and try and eke out savings elsewhere. And other brand owners have not communicated their stance yet. So, yeah.
Yeah, still a very fluid situation, but yeah,
beg your
sounds
pardon,
overall
yeah.
it's overall in the South African, Southern African, East African markets you are, it's not really going to be a major impact, it sounds like, at this stage.
I mean, you know, in the short term, I'm more worried about exchange rates, you know, so that that'll impact us more than tariffs. So in other words, if the rand, you know, weakens by 3, 4, 5%, no manufacturer can absorb that, I don't believe, and they'll pass it on. So my concern's more around shopper and consumer at this stage.
Duncan, if you take a look at that great slide you've got with all your brands and how they fit into warehousing and distribution on one side, and then you've got like retail execution and advisory in the middle, there's a lot of overlap. I see a lot of the same sort of logos sitting in both. When you are building out businesses, acquiring businesses, etc., do you specifically look for businesses that are quite vertically integrated and actually do seem to play in both? Or are you quite happy to own specialists particularly? It's just interesting to understand how these sort of building blocks all fit together.
Yeah. So it's different for different markets. So if you look at in South Africa, for example, we don't do distribution, and we're very deliberate around not doing distribution. And so in South Africa, we have enough scale to build a sales and merchandising business only. And we've done that very, very successfully. In markets north of the border, our clients have tended to want a full service offering. So you heard me talk about reducing complexity. So they want to be able to outsource it to a credible service provider that can execute all those services. And I'm supplying a couple of thousand retail stores, and they're collecting one check from me, and they know that their brand's adequately represented in country. So generally speaking, north of the border, we provide full service offerings, and in South Africa, specialist services only. When we look for businesses in existing jurisdictions, it's around what acquisitions I can do that can broaden my service offering. And you heard me talk about South Africa, where we bought the Roots. That for me was around channel broadening and really doing more with existing clients, and ultimately over time creating barriers to exit. And you know, if you look at the digitization journey space, we're looking at acquisitions that can act as a catalyst for, I guess, digitization implementation in the business. So that's what would inform that, sir.
Duncan, I've got another one more around AI within a business like yours, specifically on the advisory and the analytics side. You know, I just see it coming more and more and more, even with you know, other companies I hear from and deal with. I mean, are you starting to implement it and get benefits from it in terms of, you know, what you can provide to clients, whether that's, you know, data analytics on sales, you know, better stock planning, actually leading to reduced, you know, stock? Because I can imagine, you know, in a business like yours, if you can optimize stock by 1.5%, it doesn't sound like it up on the amount of stock that you're required to hold. And if customers are happy to knock that down by 1% or 1.5%, I mean, it has a massive capital impact. So maybe just touch on the potential for AI to kind of actually deliver real bottom line numbers into a business like CA&S.
Yeah. So Mark, I mean, you know, we do, so where we're doing the project is actually on the debtor side. So for every invoice, we have a delivery note. For every invoice, we have a delivery note and a credit note. And so we have tens of thousands of manual transactions where we're deploying bots in that space to do exactly what you're saying, making sure we can manage the debtors book and make sure that we can collect the money earlier. I'm going to, Francis, you know, I guess in charge of that project. I don't know if there's something he wants to expand on, but, you know, that's been our first foray. So we did it in our Namibian business, we did it in our Botswana business. And as we learn, the idea is that we expand it into other geographies and other areas. So I guess is, you know, we're at the beginning of that journey. And we probably did it for the first time about 18 months ago in our Namibian business with very, very good results. I'm not sure if there's something you want to expand on.
I think it just helps with accuracy and sorry, Mark. I mean, all this technology and everything, I mean, everything changes by day, and it made a huge difference. And we're looking at data lakes, centralizing information, look at trends. As you mentioned, as you can recall in previous recordings, Duncan referred to the Namibia organization where the trends have changed to the north, where people moved from Windhoek to the north and the sales. So all of those things we take into account, and we could do that because of our data lakes and information available, even to small skills like a lunch bar, how much a lunch bar costs and where a lunch bar is sold. So, but it's a journey. You need specialized people to look at it, and they are expensive. But I mean, there's good traction, and then we're starting to get some results out of this digitization process.
Thanks, Franz.
I have to ask the question about Botswana because I think it's top of mind for most people when it comes to the risks around CA&S. So obviously, I mean, it's something I've been writing about for a long time, is lab-grown diamonds. And I think people have finally realized that it is a very serious issue. Obviously affects De Beers, which affects the Botswana economy. And that's about half of your group is Botswana. So I guess just plans in place to mitigate that. How should investors be thinking about this risk on the ground? And then, you know, as you work towards your 20 billion revenue target, is the goal that the rest of the revenue is coming from places outside of Botswana? It's just good to understand how you see this evolving over time.
Yeah, thanks, Ghost. I mean, you know, I think that Botswana is 50% of our revenue contribution. But, you know, 8 or 9 years ago, it was 100%. You know, that's where the business started. But I think that, you know, not only are we worried about the impact of, I guess, synthetic diamonds on the fiscus, is because I guess government is the biggest employer there, etc. We also had a change of government late last year that looks to have gone smoothly. The interesting thing around Botswana, you know, it has proven to be quite resilient in the sense that we are showing revenue growth. If you look at the retailers, Cephalana and Choppies, both of them, I think, was for their half years, France, both showed revenue growth. I think one of 7%, the other one at over 19%. We are not seeing the impact on volumes at the moment, although we monitor it very, very closely. But from a group perspective, we ideally don't want any jurisdiction to contribute 50% of our revenue. And so, you know, you'll see that we've actively grown Namibia, Eswatini, and South Africa. It's just that Botswana in the mix has continued to perform as well. but the East Africa expansion is an opportunity, but also an important part of us having a sustainable, profitable, and predictable business. And, an important part of that is the risk mitigation. So, I think that we certainly don't have our heads in the sand around it. We watch it closely. And I think that we're actively looking at ways to make sure there's, I guess, less reliance on Botswana over time. I think that the government in Botswana has been fairly proactive around growing industry, providing incentives, making sure that, the economy is diversified, not only agriculture, but also industrialization, et cetera, et cetera. So I think there's lots of stuff on the go, and I expect that over time to get some traction.
We might just squeeze in one last quick one, Duncan, if I may, and we might just stick on Botswana, as as we know, the business kind of originated there. I'm just wondering, as South Africa becomes, bigger and bigger and bigger, and just this, the differential in scale of the two economies. Does it make sense to, keep the primary listing in Botswana versus, swapping them around, primary in Johannesburg and then a secondary back in Gabs?
Yeah. Mark, I think that Frans will be cross with me if I don't let him answer the question. So,
or just even the compliance and complexity of maintaining the two. Does it make sense to maybe just have one?
Mark, we love Botswana. No, I mean,
You're only saying that for the low tax France. That's all you're saying.
So our journey started with Botswana, and we listed, our first listing was on the Botswana Stock Exchange. So they prepped us to move over to the JSE. I mean, we've got good shareholders in Botswana, and we value their contributions, directors wise, non-director wise, and advice. So I mean, cost wise, it's irrelevant. It's not that high, Mark. Compliance, to be honest with you, compliance is almost exactly the same as with on the JSE, and it's just a normal process of doing all the compliance and things. It's just here and there's few things that's different, but we navigated that area. But we're still proud to be listed on the Botswana Stock Exchange. They're still one of the top 5 exchanges in Africa, biggest exchanges in Africa. So
Yeah, and with regards to cost, I think it probably costs us less than R1 million a year.
That's less than that.
Even less than that. So I think that the compliance framework is no different. So I hope that answers the question, sir.
Yeah, and we'll leave it there, and I'll just hand back to Vanessa for some closing remarks. But Duncan, Frans, thanks very much from my side for joining us once again.
Thanks to you, Mark, and your audience. Appreciate your ongoing interest in our organization.
Thank you so much. Thanks to everyone who chose to join us today and spend time in this session, and a special thank you to Duncan and Frans for making time to support this retail investor platform and to engage with the investors. We hope that you've enjoyed the event, and just as a reminder, if you want to listen to it again, it will be available on our Unlock the Stock YouTube channel soon. And we do encourage you to subscribe so that you know all about the latest videos. Our next session is on Thursday, the 24th of April, and features another regular to Unlock the Stock, and that is Astoria. Until then, be safe over the holidays, and that's all from my side. Thank you very much, everyone. Goodbye.